truly and honestly though, this really has been a whole game changer. I'm gonna cry. No, it's been a big deal. We've done this for 10 years and it's exhausting. And we work really hard, and we just have been to a place where we took our first vacation for the first time in 12 years. We had the time of our lives, and we felt like, okay, we can go off the farm for a minute. We can do it. And it's not always going to be perfect, and I think we're always going to worry, but I think anybody that has felt the way that we felt should do this program.
Legacy Farmer has helped me understand my own business better. I know what's going on. I can see it better versus QuickBooks. It's just QuickBooks. Because I'm tracking my finances now, I can relax a little more, spend more time with the kids, spend more time doing whatever other than sitting in the office and beating my head against the wall.
One of the hardest things, or one of the biggest challenges we had, was just through our operation was actually determining if we were even making money or not. But Farmer Metrics, basically what it did was it allowed us to kind of deep dive into the true cash flow of the farm and the projections that kind of go from there. And then it helped us segregate out basically our real assets and kind of how they look, and it just showing that type of stuff as well.
Legacy Farmer has helped us focus, gain more clarity in our financial position, as well as our mission, our goals, and our values.
Since I've had Farmers Metrics, the tables have turned. I'm basically back in control of my operation.
That last meeting shook me. At this age, if I do the things right now, I'm not going to have the struggles at 60, 70.
The community and resources have been great, and this was what I was looking for. I feel awkward asking questions, and either do they. So it's awesome because it's farmers doing the same thing you are, and they're looking for a more efficient way to farm and make money. And also there's shared knowledge like average interest rates across the operating loans and things like that. So like if you're being charged too much for a certain item, or you're above average or below average, or your costs are above average, and you need to work on a certain part of your business to get it closer to average and making more money.
Hello, everyone. We're really glad you're here with us today. We're excited to be presenting on this topic that we've chosen. I think all of you are aware there's a lot of uncertainty around the ag markets. Katie and I, who are presenting today, have talked extensively about this, and we thought we'd dive in here and share some of our thoughts. So moving into this next slide, I want to cover a few of the key topics. We're going to talk about commodity markets. We're going to dive into trade policy. Tariffs are on the forefront of everybody's mind. We're going to talk about what's going on with the equipment, where we're going with that, thoughts on equipment and how to handle that, input costs, as well as the banking environment. Nobody seems to understand what's going on with the bank, and of course, why interest rates are what they are, and then diving into government policy. What's that's going to look like in the next 4 years and potentially beyond that. So before we do that, I'd like to introduce ourselves. I'm Lance Weaver. I'm the Director of Business Coaching. I grew up in a little town called Levelland out in West Texas. I grew up working on irrigation wells and center pivots with my grandfather. Really drove my passion in agriculture. Went off to Sam Houston State, where I got my undergraduate in ag business. From there, I went to Oklahoma State, got my master's in ag econ. One of the key events that I went through while I was at Oklahoma State, I had the opportunity to go to Washington, D.C., experience firsthand the Farm Bill process. I got exposure to ARC and PLC, as well as many of the other government programs that we're dealing with. I thought that's what I wanted to do with my life until I got kind of that firsthand front view of dealing with our American political system and realized that wasn't for me. I felt like there was a lot of people attacking the American producer, and I wanted to go into a role where I could serve you guys more directly. Ironically, I ended up in banking. Had a very successful career for about 11 years in banking, but found the banking environment above me was a lot like the political system that I disliked. And I was looking for an opportunity to go elsewhere. Lucky for me, I got to come here and work with you guys doing what I think is the heart of agriculture and helping you guys get your feet set and move forward. Now, we also have Katie Taylor here on the call. She's our market specialist, and I'd like her to spend a little time introducing herself.
All right, I'm so excited to be talking to you guys today about some of these really important topics. My name is Katie. As he mentioned, I grew up on a row crop farm in Minnesota. So I got my interest in agriculture from a young age and wanted to kind of continue that by pursuing an education in agriculture. So I went to the University of Minnesota studying animal science production and ag business. I had the opportunity to work on the trade desk at CHS while I was in my senior year of college. So that kind of got me into the commodity markets, futures and options, and really diving into some of those financial topics. Then after I graduated, I was offered a full-time role as a commodity broker there and continued that experience working with ag businesses, processing plants, elevators, and of course, producers and farmers as well, really helping to kind of take these complex financial subjects and markets and make them more simple, allowing people to kind of have actionable insights on, with all the noise in the markets, what do we do? What's the best step forward to protect our bottom lines? Enjoyed that time a lot, and then had the opportunity to move over to Cargill and do some internal risk management for their feed team. So same kind of idea, working with risk management, really getting to understand these markets very well as the futures markets and options, but as well as the physical side on the feed side. So DDGs, wheat mitts, some of those harder to trade items. And then kind of missed the customer facing side. So I moved over to cargo risk management, where I got to work again with producers and consumers as well, but more on a swaps, OTCs, and structured product space. So just kind of continuing my knowledge in all of these options that we have when we're trying to manage risk. And then I also went and pursued my master's in finance at Penn State as well. I've always just wanted to focus on helping farmers and being able to kind of educate and give all of this experience that I've gotten to them. So it's been a great opportunity to come work for Legacy Farmer and get to actually take all this knowledge from my career and my education and start applying that to focusing on marketing and business for them as well.
Hey, thanks, Katie. As y'all can tell, we look to hire the best, and we feel like we definitely got a good one there in Katie. One of the things that we get to experience as business coaches is all the chatter that goes around the commodity markets. We hear all the ups and the downs, the super optimistic and the pessimistic. And here lately, the corn market's been a little bullish. I want to open this up to Katie and kind of get her insight on what's going on there and kind of dive into some more of the fundamentals.
Yeah. So as he said, the corn markets have kind of been experiencing a bit more friendly chatter recently, with most of that focused on old crop stocks. We have essentially seen some of the tightness come in just due to strength in U.S. exports. Mostly we're seeing like a really decent year-over-year growth in that exports, which have gone above what the USDA had originally projected for growth. So that's really positive for the market, especially in a time right now when we're so worried about trade flows. We're also kind of concerned in looking at potential supply issues. With having a tighter stocks, we have to focus more on those things and how they can affect the market. For example, if Brazil had any flooding or port delays, those could make current picture even tighter. And then on this topic of the trade war, we also are seeing new buyers come into the market to kind of help with those trade deficit calculations. So there's another source of demand that's kind of already pushing these tighter stocks even tighter. Additionally, the weakness in the US dollar has been a big chatter in the market, and that is supportive as it points towards us getting additional export business there as well. And then another main thing we're watching right now for corn demand is the waiver in E15 sales this summer that was recently announced. That could really boost corn use for ethanol, especially since we're already seeing higher crude prices around that $60 a barrel price line. So those are some factors we'll be watching on the demand side. And then for supply, we'll also be keeping an eye on weather issues in Brazil. The 2024-25 crop was a record crop, so that's keeping some of that pressure off prices right now. But if we have any issues with the safrinha crop or problems with crops in Ukraine and Argentina, that could further push export demand to the U.S. Now, if we're looking ahead and thinking about U.S. production in next year's crops, I think we do have to address the elephant in the room. The USDA reported that they expect a large number of acres to shift to corn. We've been talking about it for a while. On top of that, plantings have been going really well. We've seen those crop progress reports come in far ahead of the 5-year average. But with all that being said, we're putting a large weight on this year's crops to make up for those tight old crop stocks. So it'll be really important to kind of watch weather markets this year. We're seeing what looks similar to the market in 2013, where we saw those large planted acres due to the price rallies in 2012. But at the same time, we actually saw more planted acreage in 2012. So just important to keep in mind that this year's crop is going to face some of those additional weather volatility and some of those kind of risks to the market, especially when We're facing some of those yield issues as we have more acres. There's more acres that can potentially have yield issues. Some of those ideas are just things that we want to pay attention to, especially when we think about like the funds, for example, and how much their control in these markets can push prices up and down in a quick sense.
Yeah, that's really interesting. And then when we look at the corn market rallying right now, we've got a lot of wheat producers that we consult on a day-to-day basis. I'm awful curious, like, what is that going to do for wheat?
Yeah, so we do often see a pretty good relationship between corn and wheat prices. So we can kind of expect that if corn rallies, wheat will follow to a sense. Another thing I want to point out is just the spread between corn and Chicago wheat. We like to watch this spread as it can kind of signal demand shifts, especially in the feed sector. Usually when we approach that 50-cent mark between the two is when we start to see wheat push into rations and corn push out. Currently, the picture for wheat, I'm not going to lie, it's not super friendly. But I do think we could see some additional demand flowing into these markets in the near term, just because that spread is currently sitting around 55, 56 cents. And then we also have seasonality working for us in both of these markets over the next month and a half or so. So I think there'll be some good times to take advantage of those seasonal price swings and potentially that demand shift. But the overall S&D is probably not super pretty for wheat at this moment.
Yeah, and we saw that some when we were helping producers with ARC and PLC payments, which we'll talk a little bit more down the road. PLC was heavily favored on those wheat base out there, which that makes sense with what you're talking about there. Kind of moving on to soybeans, there's a real negative sentiment around beans right now. Can you tell us a little bit about that?
Yeah, absolutely. I think there's a lot of concerns with soybeans, of course, just on the China side. And the market is going to continue to trade that headline for the time being. However, I would like to point out some bright spots, mostly on the product side. When we look at soybeans themselves, the market has recovered a little bit from those initial lows from the tariff headlines, but we're still below the highs we saw this winter. However, if you shift views to the soybean oil market, we've actually seen a really good run up in those prices recently, with a lot of that being caused by a massive spike we've seen in export demand. So this marketing year specifically for oil is showing heavy demand on the products for both typical buyers as well as some new players in the market, such as like India and even China. With China, we typically see more purchases for beans rather than products, but they've actually shifted some of that demand to oil as well. There's also a lot of biofuel growth in some of these countries with newer mandates being put out in some Southeast Asia countries as well. So that's something that can help lend us demand on that side. Just to kind of put that in perspective in terms of what we're seeing for like USDA numbers, we've seen the USDA adjust the soy oil demand number on their WASDE 5 times this year already. So there's just kind of this expectation that this will continue to grow. It's painting a pretty nice picture. There's some things developing with biofuels as well. So I think it's nice to have a little bit of optimism rather than having all this negative sentiment with the tariffs. So it's just something I like to point out. Still, obviously have to worry about the trade flows, but it's good to view that kind of demand flowing in.
That's really good stuff, and that kind of leads me to think about the oilseed product demand. How's that going to affect the canola market?
Mm-hmm. Yeah, this is a great kind of comparison between the two. It ties in a lot with what is happening in those soy oil and biofuel markets as well. And on the other side with canola, we're actually seeing a really tight market just on the supply side as well. So we have those trade flows surrounding the veg oil demand that I kind of mentioned too, which is helping to prop up markets. And we've seen a lot of that spill into canola prices recently. We did see that sharp fall in prices back in, I believe, March, after the 100% tariff was placed on canola oil and meal imports into China. But since then, we've seen a really quick rally back up higher, just as the market focuses less on that headline risk and more on the actual S&D we're seeing. Also, while China is essentially blocking oil and meal imports, they've actually still been an aggressive buyer on the seed side, which has been pretty friendly for that market, especially when they took advantage of the price break that their headlines caused in March. And then, of course, we're also kind of thinking about on the biofuel side, part of that portion of the U.S. tariffs is the used cooking oil market. It's a big chatter in terms of biofuel. We've seen a lot of that flow into the U.S. over the last couple of years, which takes away demand from other veg oils like soybean and canola. So now that we have kind of that used cooking oil leaving the market, we're going to see a new space for canola and soy, especially with that USMCA compliance that's going to allow for us to continue to bring canola flows into the U.S.
Okay. Well, I'd like to segue away from grains and oilseeds a little bit, and I think we would be remiss not to talk about the forage market. It's a little harder to predict. We don't have something tracking on the board. Can you tell us kind of what your perspective is on that?
Yep, absolutely. I think one challenge, not including the more obvious weather issues here, would be the export market. I think it's good to think about this in terms of how those tariffs and how those flows are going to affect the forage market more specifically. I know we talk a lot about soybeans and corn, but it's also important for hay as well, some of those flows to China and Asia as well. We did see a decline in exports the last couple of years, and it's likely we'll see that similar pattern again for China just because they're taking a majority of our hay exports. And while tariffs are part of it, it's also just the fact that they have a lot of pressure in their dairy market. They're not very profitable just due to the way that it's kind of been working out the last couple of years there. So it doesn't make as much sense for them to be importing that from the US at this moment. So I can't imagine we'll see that demand show up like we saw. I think it was like 3 or 4 years back, we saw a large spike in Chinese demand. But we could see some increased business to like Japan, who's our second biggest buyer. They've been on a trend upwards as well. And then some of that volatility in the other feed stuff, like corn, for example, could lead to volatility and price support in hay as well. So I think there's some opportunity here, but it is important to kind of understand the risks of where that export business could lead us to.
So in summary, I'd say there's a lot of risk, there's a lot of uncertainty, and really kind of gets back to something we like to preach here, guys. We really need to be planning for the 2025 year. We work hard with our producers to focus on projections, measuring projections, and I'm hearing stuff come from Katie right now. The cost of forage could go up, the cost of corn could go up. That's going to affect our feed. We have droughts in certain circumstances. So I want to dive into one of my favorite topics to all my customers out there that know me very well, the livestock markets. And so Katie, what are the analysts saying about the cattle market over the next few months and kind of how that's going to affect the common producer?
Yeah, I think it's pretty safe to say here that the short-term trend is going to remain strong, especially just kind of considering those major fundamental factors around there being fewer cattle. We're also seeing really strong consumer demand on the cutout side. So despite these high prices we've seen, we're still seeing that demand flow through, which is pretty positive for the market. I imagine we'll continue to see that volatility in coming weeks, just as the tariff and recession headline risk continues to exist in the funds, of course, especially. But it's still nice to see that demand is flowing and that the tightness in stocks is leading to those more supported prices. I think it's important to note on the demand side that we are starting to see those effects on beef exports to China already. So those exports have fallen off. I believe they're at their lowest level since the beginning of COVID now. So it'll be interesting to see how that affects some of the prices, and then maybe do we see consumer demand in the U.S. ramp up to help with that loss? But on the other side, we'll have the opportunity to see if other countries pick up purchases again to help with that import trade deficit calculation that was going into that original tariff proposal. And then another thing just to mention, just kind of watching these cattle on feed numbers over the next few reports, especially the heifer placement. We're going to want to watch if there's a signal that we're starting to see that heifer retention and herd rebuilding, because the market has been signaling that we need that. We're currently in our 7th year of contraction and a 12th total year of a cattle cycle, which is typically 10. But that'll be something that I think will signal how long is this going to last? Are we going to continue to see these higher prices? I think there's a fear that people don't want to rebuild their herd because it's temporary. That's probably a safe expectation to have, just because the higher you are in these markets, the more downside risk. So just utilizing some risk management tools and really understanding your bottom line is going to be super important in this market, just because we have so much more at risk right now.
Absolutely. And guys, I want to stress that Katie's not saying that this market's high, so don't get a risk management plan. Really pay attention to what she said there at the end of this particular segment, because we are at the highest levels we've ever seen. Even though demand's supported right now, the fall could be great. And so from the former banker me inside says, know your break evens, know your projections, and have a plan. Or it could be you that is looking for a new profession at the end of the year.
Mm-hmm.
Okay, let's segue into dairy. How do you currently feel about different dairy markets?
Yeah, so unfortunately, the picture for dairy markets isn't too pretty right now. We're seeing pressures on both the supply side and the demand side for both fluid milk and products as well. In fact, today we just saw spot butter prices fall to their lowest level since 2021. Supply has been pretty stable as of late, and demand has been lacking. So that's just been kind of continuing to paint this picture. I don't see us getting out of it at any point, especially right now. That pressure is mounting just on the near term, just as spring flush takes hold. But it's tough to say. The one question that is arising right now with this market is kind of the expectation on how some of these tariffs with the EU will play out. There's some optimism that they could be used as leverage to fix some of those non-tariff barriers that we have with U.S. dairy exports, specifically with the EU. There's some concern as well with India and seeing if we can fix some of those trade flows. So I think there could be an optimistic picture in the further future for how those trade flows could maybe be better for U.S. producers. But in the near term, I do think we're going to see some heavier risks in terms of prices. They're not going to be great. We have a lot of supply right now. So it's really important to understand, we talk about this a lot in Legacy Farmer, but really understand your cost of production and your break evens and try to make those kind of small little adjustments across your cash flow to make this work for you at this moment.
You bet. And, that kind of leads me to think about inflation and the interest rate risk that we currently have, especially when it affects the cattle sector. Guys, you really have to pay attention to what you're doing on heifers. You have to pay attention to what you're doing on the marketing side, but there's a cost side to this too. With rising interest rates usually means that input costs are going up as well. We raise interest rates to combat inflation. That's your signal that having a hold of your projections, having a hold of your expenses is going to be the key to your success in the future. So I can't stress enough. And I hope you understand that by going into depth with these livestock markets, these commodity markets, we're stressing the need to have a plan. We focus on that extremely hard in the Legacy Farmer program, not only in the single year itself. We're looking down the road to 3, 5, and 10 years and setting those metrics out. If you're not measuring, somebody next to you is measuring how they're going to get to that goal. And those guys are going to be the ones that get the best deals on their land, the best deals on their cattle, the best deal on their crops, and then ultimately are the ones that succeed at passing on their land to the next generation, which I know is at the heart of a lot of our operators on this call. So please let us help you with getting to those levels, because I think that there is a path to success in agriculture. With all this uncertainty, there is a chance to take advantage of the uncertainty and make it work for you. But it comes with setting down and understanding your numbers. So let's dive into trade policy. I want to caveat a little bit about trade policy first and foremost. A lot of people don't even understand what a tariff is. It's a tax on another country to do business with our consumers. And so what does that mean? The cost of selling goods to the United States has now gone up, which in theory should make our domestic markets more competitive. But it doesn't always work out just favorably as it should. There is a long-term plan here. We've been in a very rough situation in the United States. And honestly, we've been in a trade deficit where it's been somewhat easy to sell to our consumers, but it's been harder for us to sell to other countries. So the idea behind the tariff war is to kind of level that playing field. There is going to be some short-term pains, and we're going to need to expect that. Once again, comes with planning, comes with risk management, talking to people like Katie that can help you manage those markets. But let's dive into a little bit more of the particulars about it. So Katie, let's just do a little bit of an overview of how that you feel like that's going to affect the output prices in the market right now.
Mm-hmm. Yeah, so I don't want to be too repetitive because I know I've mentioned some of these things while going through each individual market, but I think it's really important to stress that just volatility as a whole is going to continue to be a market risk going forward. We have a lot of funds in these markets. We have a lot of external factors that are going to affect your output prices. So when we're thinking about our farms and our businesses, it's going to be more important than ever that you understand your numbers and you can apply that understanding to something like a solid marketing plan. Don't want to go too hard on it, but we got to get a marketing plan in place. It's very important, especially in a year like this. I think people have this mentality of, oh, my dad never marketed or my grandfather never marketed. The markets that exist today are not what they were even 5-10 years ago. We have so many more external factors in this. So that's something that I really want to stress. And another thing that comes with this issue of volatility is emotion. It's really important to remove some of that in order to keep your business profitable, because when emotion comes into these decisions is when we don't make those decisions. You know, we watch corn drop, we watch these prices drop, and we continue to wait and have this perpetual bullishness of someday it's going to correct it. Oh, I should have sold last week. Now I'm just going to wait till prices go back up to where they were last week. And it just keeps going around in this cycle and it never really ends. So yes, we're seeing that near-term risk with tariffs and we're going to have to deal with that, but it's just really stressed in actually having a plan and using that to make sure that your business is running efficiently.
So one thing I want to address here is, guys, just because you don't have a futures position or options position does not mean that you don't have a position on the market. The minute you stick a seed in the ground, the minute that you raise a calf, you are now exposed to the market. By choosing not to have a marketing plan, you're choosing to be a speculator. And I'm going to tell you, I've been doing this for a long time now. And I'm going to say the agricultural sector and the producers that I love, which is all of you guys, are the worst speculators on God's earth. You need to understand that we have people that are trained professionals in order to help you guide through this. Do not listen to your neighbor. Do not listen to your friend. Do not listen to your family members. This is an important decision that's either going to keep you in business and thriving for the future to reach your long-term goals, or it's going to be the reason you're not in business. And we can't stress it enough because I've seen it happen over and over again. Let's keep that from happening and let's get a marketing plan. Let's get a hold of our costs and let's understand where we're going as the agricultural sector. It all starts with you, my friends out there in the fields, planting, harvesting, doing the dirty work. We're here to help you with that. So, Katie, you want to jump into equipment here and kind of kick us off on equipment, because equipment's a fun topic.
Mm-hmm. Yeah, I'll kind of just do a quick cap on input, but then, the next slide we get to talk about equipment, which is always exciting. So, well, like I mentioned, we'll dive into those specifics in the next few slides, but I think it's important to note, as Lance said, losing trade flows is the product of retaliatory tariffs. We also have to focus on what the actual tariffs are and how that will increase our input costs. Just that basic idea of not only is it goods that could be coming in finished, but also when a company needs to import parts for its products, we're going to watch those costs get passed on to the consumer. So just again, really coming down to managing those costs. The only way you can really do that is if you understand your numbers and then are able to make educated decisions based on those. So we can kind of hop into some specific input costs. And I know equipment is a huge one of those. And I hear Lance talk about equipment pretty often. So what are your thoughts on the current equipment market? And what do you think is going to happen to these prices in the long term?
Guys, we've seen a huge run up in equipment costs. I know I'm preaching to the choir here. Starting with the pandemic, the supply chain problems that we saw, equipment prices just blew through the roof. Equipment is a terrible asset. Stop thinking that, I'm going to buy into this equipment. It's going to be a valuable asset for multiple years. The starting price is too high. When you really think back and you kind of take a step back in your operation, you think about the harvest equipment we're paying for, the combines, the cotton strippers, the swathers and balers. Those things are, in some cases, 5-10 times higher than what our grandparents were farming with. It's become such a large portion of our balance sheet. So what does that mean for our operations from an operational standpoint? Is that where we want to be parking our money? Well, it doesn't really matter. It is where we're parking our money. Well, it does kind of matter, guys. We need to be parking our money where it works for us the best. So I really, really preach, guys, we got to stop thinking about these things as assets and start treating it more like labor. We got to find a way to get into equipment, good, healthy equipment that doesn't rack up a bunch of maintenance expense, and then we can get in at a cost-effective rate. We at Legacy Farmer have developed actually a tool to really evaluate the cost of ownership in machinery. The first part of cost of ownership is your entry point. So if you're buying a stripper baler at $750,000 or you're buying a combine at $900,000, you have to understand immediately the cost of ownership in that machine is much higher than what probably you projected even 5 or 10 years ago. And I hear all the excuses. I hear, oh, we're more efficient. We're reducing labor. Oh, yeah. I get it. I understand. We got to have it. But the reality is it's not a long-term asset. It's not an asset that we want to invest in. So what do? We look at alternative options. We look at some leasing options that are out there. We understand the costs that we have in our machinery. Maybe it makes sense to custom some of it. And I know that's a touchy topic because maybe they don't get in time and stuff like that. We have to start evaluating equipment on a case-by-case scenario. We have to really dive in, get to the nitty-gritty, the nuts and bolts of what's going on. Nuts and bolts, nice little pun there, of what's going on, and understanding who is contributing, who's our players, invest in those players, but keep our costs low and push our investments to the top and bottom part of our balance sheet. That's how we create a legacy for our future. That's how we create a succession plan for our kids. Because if you get too heavy on the equipment and it starts taking up 50 to 60 to 70% of your total value, guys, we're headed down a path of demise. Let's rethink that. Let's work here. We can help you over here at Legacy Farmer really understand those costs, dive into those things, and understand how to make a good high return on that investment. So, moving into kind of the next thing I'd like to talk about, there's a lot of equipment manufactured in the U.S. And I think a lot of people are concerned with the tariff market and how that's all going to play out on our equipment prices, guys. The tariff war we're going through right now with China and the other Asian countries out there, it would be crazy to think that that's not going to affect equipment prices. They manufacture a lot of our rubber, a lot of our steel, a lot of the plastic that goes into our machines. But ultimately, the actual manufacturing, the assembly, most of our wheeled stock is made here in the U.S. Now, we do have to be concerned a little bit about what's going on in Canada. A lot of our implements, the things that go on and make the job actually functional, those things are coming in. Air seeders, almost all of those are made in Canada. So we have to be mindful of what that looks like. So what does that mean in terms of planning? That means having a plan, looking out 5, 10 years down the road. What are we going to need? How are we going to invest now to keep those costs under control, to stabilize the plan for the future? So it all comes back to the same thing we keep preaching. Stabilize what you can stabilize. Control what you can control. You can control yourself by really managing your costs and having a marketing plan. That's what this whole thing's going to come back down to. And I know those are not fun topics. Those are not fun things to really talk about, but it will be what separates you from your neighbor and your ability to grow while they're going out of business.
Yeah, I definitely agree with kind of talking about some of the input prices too on some of this equipment. I think it's another important thing that people have been chattering about a little bit more recently is the empty ports that we're starting to see in the US. Lance mentioned, we saw this run up in equipment prices with the supply chain issues in 2020. We have to consider, are we heading into a similar supply chain issue as companies aren't currently looking to order items because there's just so much unknown with these tariffs. There's that mentality that Trump could come out any day and rescind some. So why would they buy now at these higher prices? So being kind of active in understanding what's going on and not purchasing, maybe holding off on decisions to make sure that the market is aware and we're not dealing with supply chains when you need to buy a new tractor.
So there's a lot of concern around input costs right now. And I would say that producers really need to be focusing on those elements that they can control. Some of the things that we can control is advanced purchasing of fertilizer, fuel, seed, making sure that we get in at the right price. But guys, that's not a very simple equation. You got to understand what's going on there too. Most of you guys are operating with an operating note. You're paying anywhere from 6 to 9% interest, right? So if you purchase fertilizer ahead of time, then you have to understand there's a cost of carry. So you need to get a deep enough discount in order to get that purchased at a price that is palatable to your operation. Where does that come in and where do we make those decisions? You got to understand your numbers. Let's right back to that again. One of my favorite tools in a farmer metrics is a tool called field metrics, where we break it down on a field by field enterprise level, and we can really project out what our profit and loss is going to look per enterprise. So we go purchase fertilizer. We need to know exactly how much and what our budget is. If we can buy it within that budget and stabilize that component, guys, that's a win. If you start thinking, oh, well, fertilizer prices are going to drop, Trump's going to do this, Trump's going to do that. Once again, you guys are the worst speculators on God's earth. Remember that. Take that message away. We don't want to be speculating on more than what we have to do. The number one farm problem they preach to you in Ag Econ 101 when you get into school is that farmers are price takers. So what does that mean? We're exposed to the market. How do we fix that? We find ways to stabilize those costs, be smart about our purchasing decisions, and have a freaking marketing plan. Don't leave yourself exposed. The level of uncertainty is an indicator of risk. So what does that mean? If we're so uncertain, the risk is high right now. Let's really dive into this. Let's understand these numbers, and let's make sure that we stay in business for the many years ahead of us here.
All right, now we just kind of wanted to show this chart to really kind of drive that point home of how much we've seen inflation affect some of these on-farm expenses. So really just what we've been talking about in terms of, large interest expenses, especially fertilizer being significantly higher, and that trend will likely continue with some of the trade flow effects of the tariffs. Fuel and oil is one that I think is important to discuss because we have to be realistic in the fact that we probably won't be seeing more U.S. production. We're probably not going to see prices drop due to anything U.S. related on like the distillate side. Refineries are already at kind of max refinery utilization. So there could be some outside factors like OPEC increasing production. I know we had some headlines today that drove crude down a little bit, but just being realistic and not expecting our president to be able to fix a market like that is so global and based on so many other countries.
And the other part of that too is, guys, understand that crude is not gasoline, diesel. There's another step that's involved in that. It's the refining process. The U.S. doesn't have a whole lot of new refineries. EPA's kind of put a cap on that. And that also helps, or that actually curtails our ability to really control prices, help the farmer out, help the industries out. It's because we can only do so much capacity before there's nothing left to do. So don't get too hung up on the actual crude price. You got to be smart about it, just like you would with fertilizer. There is some correlation with fertilizer and natural gas. Urea is obviously kind of a product of natural gas, and so we're going to need lots of fertilizer this year. And if we get some rain, we ought to be pushing that. That's going to drive up the demand for fertilizer. And then obviously with the corn price going up, that's another indication. And then what's happening with the tariff market? Back to the original message, controlling your costs, understanding your costs, and getting ahead of your costs is going to be the key to success for this year and really for the years to come, because the volatility has continued to increase every single year. You guys know this. Seed technology is more capable than it ever has been, but the top and the bottom are much wider than they used to be. So we have to be mindful that volatility is also seen in the market. And we have to understand what we're exposed to as producers in the industry. And as we look at these costs here, inflation of farm products, what is this going to look like in a year from now? Do you want to be exposed to that? I'll look at chemicals. A lot of our chemicals are manufactured overseas. If some of these tariffs really hit, we're going to have a problem. Are we going to let that problem define us? Are we going to really get ahead of it, be proactive rather than reactive in our decision making? I think that's a real big question to ask as you're moving forward. Am I being reactive or am I being proactive? I want to really push those guys to dive into their model, work with people that understand your markets and aren't trying to sell you something, but really care about your operation. I feel like the people here that we work with at Legacy Farmer, they truly care about you, and we all do. And we want to see you succeed. And that's why we come to work every single day. And I think the next topic here is one that I wouldn't say is near and dear to me, but it's one that unfortunately I'm intimately familiar with. I want to explain some things that are going on in the banking environment. Guys, Jace has said the banker's not your friend. I would agree with that. They're your investor. And so you have to understand what incentives drive a bank. And I'll take a minute to kind of explain the difference that we're seeing today that we haven't seen in the future. There have been regulatory environment that allowed a bank to keep a certain amount of cash in reserve to cover their loan portfolio. Well, what happened in the pandemic is we realized that regulation wasn't enough. We saw a lot of banks go from the black to the red overnight, and they had to go and borrow money at a much higher rate than what they had it lended out to. And so that's forcing a lot of discussion about regulatory reform and how that's going to look. But the consequence to the farm is that commercial banks are tuck-tailing and running from agriculture. We're seeing this across the country. There are lots of situations where it makes sense to work with a commercial bank. You have a good relationship. The board of directors is good at managing their money and all of that stuff. But you can almost tell how well a bank is ran by the interest rate that they're willing to offer you. There is a base cost of funds in every single operation out there, every banking operation out there. In addition to the cost of funds, there is operating costs. They build that in, and then their profit margin. The guys that are offering higher interest rates are often less efficient banks. I'm going to have a lot of bankers say, oh, that's not true. That's not true. Reality is either you're less efficient or you're super greedy. Either way, I don't really want to work with you. Now you look back at the farm credit sector. The farm credit sector gets their money from bonds issued on the open market. They're usually the first one to come up and the first one to come down. When there's signals to start coming down, you're going to see the farm credit system start adjusting the rates fairly rapidly. I'm a big fan of the farm credit system because there is a set of protections at the FCA level. Now, there are 56 institutions across the United States that serve the farm credit banner. And so I understand that there are certain feelings in certain markets towards the farm credit system that doesn't always match with other areas. So when you're looking at the bank, you've got to understand you want to be with a bank that understands your business and a lender that understands your business. Rarely do I ever see the situation where they have both. Usually it's one or the other. Sometimes you have a good farm credit system with a bad lender, or you have a good commercial lender with a bad bank. So if you ever find that scenario, build a relationship, invest in them, and they will invest in you. You want somebody that understands this market. When you walk in with negative working capital, their first question shouldn't be, how did you lose money? It should be, what caused this? What did you put on your line of credit? How can I help you move forward? Are you getting some advice on marketing plans? These are things that we try to fill the gap in a lot here at Legacy Farmer. We have a lot of banking expertise in our personnel. We can dip into that expertise. We can get you prepared to have those conversations to where you're in control of the situation, where the banking environment's not controlling you. You just have to come to us. You have to invest in us, and we'll invest in you. And I think you'll be really happy with that investment in the long run.
Yeah, segueing from that, I've had so many of my customers express serious concern when it comes to meeting with their bankers. Where do you think that fear comes from?
They don't know their numbers, Katie, honestly, to tell you the truth. They don't understand why they have negative working capital. They've never had anybody teach them, what's supposed to go on your operating line, how this operating line's supposed to behave. If you're out there working off of cash, if you're selling a crop, you put it in your bank account and writing a check out of it, technically, guys, that's illegal. That's called diversion of funds. Very few people actually know that. Could be cause for foreclosure if the bank really wanted to get nitty and gritty about it. And also, here's the other side. What kind of interest are we forfeiting, or what kind of costs are we exposing ourselves to by carrying cash in our cash account and not paying it down on our operating line? These are questions, these are concerns that I think are in the belly of every producer, but they usually don't have a good lender that's willing to educate them. And there are a bunch of lenders out there. I'm going to say I probably know thousands of them. And of those thousands, I can count on one hand how many I'd recommend to the people on this call. And so I'm hoping that changes in the future. That starts by calling them to the mat and understanding their business better than they do. We can have you prepared for that, and I can help you show that. Katie can help you show that, and everybody on this team is going to be in your corner when it comes to meeting with your banker.
Yeah, at Legacy Farmer, we focus a lot on improving your standing with your banker, of course, and some of that can go into trying to improve interest rates and terms. So I'll use that as a segue. I've got some questions for Lance about interest rates and what we can kind of expect there next. So I think there's a lot of speculation and new information getting thrown out there around interest rates. I don't think interest rates are fully understood by producers. So could you kind of explain how interest rates work at the local banks and farm credit?
Sure, absolutely. I think that's a really great question to address because, like I mentioned kind of a little bit earlier, you have your base cost of funds, which is costing them at the local bank, they're taking in CDs, they're taking in deposits and money markets, and they're allowed to lend a portion of that back out as part of their investment to cover their costs in issuing those particular products. In addition to that, you also have the overhead, the cost of paying their employees and keeping the lights on. And then on top of that is a margin. So once again, you walk into a bank and they're offering you 10 or 12%, where the bank down the road is offering 6 to 8. It can only be one of two reasons. Either they're super greedy or they have a really bad cost of funds. Either way, it's a good signal to kind of walk out the door. If you're in that situation now, the way you get prepared and you make yourself attractive to another bank that's going to bring you in at a lower rate is have a freaking plan. Have a plan, control your costs, and understand where you're going in the future. That's the only way we're going to get to move forward. That's the only way that you're going to rise above this tumultuous banking environment we're currently in.
Mhm. And thinking about kind of what we've been seeing with rates lately, what do you think are some ways that producers can prepare to mitigate the impact of this new environment, and how that will impact their business?
Yeah, I think there's a lot of things to really dive in there. First and foremost, controlling your costs, less cost of capital. Ultimately, there's also, negotiating and understanding your banking model. You need to understand that. Stuff like a sweep account. People don't understand a sweep account, a two-way sweep account. You bring money in, it sweeps that night, pays down your line of credit. Bankers love them, and honestly, you should too. Meaning that you took a check down at the bank, $100,000 check, and it sat in your account for a week. What did those 7 days of interest cost you? Over time, you're like, oh, well, that didn't cost me all that much. But you do that over and over and over again. It adds up to tens of thousands of dollars that you could have used to pay down land or position yourself in a better long-term scenario. So I'm going to say that being mindful of your money, how much money you're using, and then ultimately when you build a cash flow, understanding how much money you need to operate your business is going to be extremely important. Being able to project that interest is going to be extremely crucial to long-term success in the coming years.
All right. So moving on to kind of government policy and expectations for this year. In the past, we've seen government payments help farmers with some of that market volatility and the downfalls from their output costs. Can we expect to see some of that again this year?
I think so. Guys, the two main government programs that we have is ARC and PLC. And before that, we had direct and countercyclical payments. Those are a thing of the past. They're all driven off of your base acres. Now, understand that the way that the system is set up is that Title I programs, ARC and PLC, are decoupled from what you actually plant on the dirt itself. So you have to understand what your base is. You have to understand what your PLC yield is. And that's one thing that we stress really hard when we're coaching people through, to understand where we can get that safety net and when it's going to click in. Your crop insurance agent is not a person that I would reach out to advise you on ARC and PLC. There has been this unbelievable overlap since 2014, since 2014 Farm Bill, that now the insurance agents have become government policy experts, which I don't understand, because the crop insurance actually comes from a whole different section of the Farm Bill. The only thing that crop insurance is doing that can affect your abilities on the Title I programs, if you elect SCO, you cannot elect ARC. But to get into that decision-making process, you have to understand your numbers and you have to understand what your projections are going to be on that farm for the year. So there are tools out there that are government-funded tools that we all paid for as tax dollars, whether we wanted to or not, that can help you understand how much and when that money is going to be coming in. Also understand we're making decisions right now, or we just got through making decisions as of April 15th for the 2026 crop year. So what we elected now, we won't see any kind of decision, or we won't see any kind of monetary help come in till October of 2026. So we're talking about really planning for a 2-year process. If you get payments in October of 2025, it's because of the decisions you made back in 2024 or 2025, excuse me, back up. So those are things that you need to be mindful of. The decisions you make affect you for the next 2 or 3 years. What we're seeing from the numbers that we're really diving into is that obviously wheat is triggering. PLC is heavily favored on wheat. ARC, Now, guys, I really want to spend a little time explaining ARC. ARC is not going to be a great coverage tool for you if you're trying to insure your risk unless you are constantly producing at the average of the county every single year. There are years that the county average is going to exceed your farm production, and there are years that it's going to come under. So there are times that you're going to get payments when you don't need them, and you're not going to get payments when you do. So really understanding where your risk lies starts in Title I or starts at crop insurance, and they complement each other. These are not the only risk management tools. We talk about marketing plans. Those are not government funded, but the government tools that we have out there are intended to help you stay in business. So take advantage of them in their fullest. If everybody's electing ARC, that doesn't mean you elect ARC. That means that you get deep and you understand why you're doing. Be intentional in your business about what you're doing.
Do you think there's any risk with these payments potentially being cut from the government budgets? I know there's been a lot of chatter about budget cuts lately.
I think that's an extremely good question, Katie. But if you kind of look at our current government, the president we have in office right now, if you look at the election map and who put him in office, it was rural America that made the big push and the big cry to push him in there. Don't think that goes unnoticed. That is definitely going to play into whether these numbers or whether this money is released or not. We had a temporary freeze. There's still a lot of freezes on a lot of government programs, but as many of you know on this call, ECAP was released. It's being tranched out across America, which is going to be good assistance. They wanted to rework that program. I get it. They wanted to take out the climate smart initiatives. That is not something that this administration is going to be as staunch about as the previous administration. So there's going to be a realignment of priorities. Now, let's dive into the farm budget itself. First of all, the Farm Bill is a very small percentage of the total overall budget in the United States of America. More importantly, the farm programs such as ARC, PLC, crop insurance, and all of those are an even smaller portion. Over 70% of the Farm Bill goes to SNAP programs. Now, those are good programs. Those are programs that help families all across the United States and indirectly subsidize farmers. I get it. But the direct subsidies that we're all very much concerned about continuing, those items are going to be low budgetary items. So they're going to be low risk. They're not going to move the needle a whole lot. So if it comes down to a president that was put in by rural America making the decision to let those payments go out or not let them go out, I can't see that being much of a stopping point for him. But time will tell. I mean, there's some risk here. There's risk in everything we're talking about. I look at it from a little bit different perspective. Whenever I'm looking at risk, the one that I think everybody should be mindful is that biofuel policy, because that's something that's been extremely debated over the last several administrations. And this administration, one thing, whether you like it or not, is serious about a handful of things. And so I'd like to know your perspective, Katie, on what biofuel policy looks like and if you think that's going to affect our producers.
Mm-hmm. Yeah, absolutely. So I think there's two major things we're watching here right now. It's going to be those blending mandates and then the year-round E15 usage. Recently, this week, we did see the headlines that the Trump administration is allowing for that temporary sale of E15 in the summer. So that's going to be supportive for the corn market. We should see some additional demand there, and then the higher oil prices will kind of increase that as well, especially as we head into peak driving season. So it also kind of just opens the door to like more consistent year-round use and retail adoption. That's a big part with E15 is whether or not gas stations are set up to sell it. So if we have this year-round usage, we might see more gas stations implement that, which would help spike those demand numbers on the ethanol side as well, which we're going to need some of those more domestic demand sources if we are seeing less trade flows in some of these. And then the other thing I mentioned, those blending mandates. So we're watching the biomass diesel blending specifically. A couple of weeks ago, we saw that U.S. Biofuel Coalition recommended to the EPA that they increase the federal mandates for that 2026 and 2027 year. That increase that they're proposing is pretty significant. It would be really good for the balance sheet. And it's also good to note that while we increase those mandates, we also have the part that I mentioned earlier with those UCO imports, that used cooking oil. If we cut those imports off, or if they're unattractive because of the high tariff levels, then not only are we going to see more veg oil, more demand into the biofuel side, but also that should go to soybean and canola. But majority of it should go to the feedstocks that would support farmers. Hopefully, we'll see the EPA finalize those new mandates by the end of this year. Could be sooner. I know they say they're trying to focus on it and finalize it as soon as possible, but that would be very supportive for ag markets, both just like in demand, but also the market could definitely rally based on that headline. But yeah, I think. Oh, I guess. Lance already touched on the ARC and PLC, but I did want to kind of talk about the LRP as well, being in that subsidized program. Just a really important tool to be utilizing. Of course, you have to apply this to your specific marketing plan. So if you're working with Legacy Farmer, we're going to work with you to understand your break evens and figure out what works best for you, whether it's LRP or using a different marketing strategy. But essentially, an LRP is just a subsidized put that you're able to purchase on your cattle, and the subsidy on that increases depending on how out of the money that put is. But it's a really great tool for most producers. Obviously, it's specific to your business, but I think it's underutilized because people view it as, why would I pay for something I might not have to use, especially when we see markets trending higher. But again, just want to stress, the higher this market goes, the bigger the downside risk. So it really makes sense to take advantage of something like that. Even if you're buying something that's so far out of the money, to make it cheaper, it's still giving you that floor. And if it works for your bottom line, there's no reason not to be doing it.
Absolutely. I'd like to expand on that just a touch. So this was a huge cry, a huge effort by cattle producers across the U.S. And I got to see this firsthand when I was in D.C. in 2011. They were wanting some kind of insurance product out there to help cattle producers that was similar to crop insurance. So we got this product, and what we saw is really poor utilization rates. And I can say from my banking experience that that's because cattle producers seem to be the eternal optimists. They think that the market's going up and it's going up and we're going to hit what's called a new equilibrium. I've been hearing that now for 13 years now, guys. That has not happened. I don't even know what that means. Guys, be smart about your decision making, your risk model, understand your cost of production, and go buy LRP if nothing else. You don't have to get complicated on the board. And LRP, I believe, is 15% subsidized. They publish rates all the time, and it can get really cheap if you get out of the money. That's why we talk about insurance break evens and marketing your profits within Legacy Farmer. Let us help you do that. We'll help you see that. We have good relationships with crop insurance agents, and obviously we actually have a crop insurance agent we work with pretty religiously, and I know that he believes in it as well. It's a very cost-effective tool to mitigate that downside of the market.
Mm-hmm. Absolutely. So I guess just putting all of this information together, what does it all mean? Lance, with your background in banking, could you kind of give us an insight of how we can be creative with financing and maybe help manage some of these risks in the next year?
So I'm going to first talk about something that's not that creative. It should be fairly intuitive. You got to look at your line of credit and make sure that what's on your line of credit truly is input costs. If it's not, we need to be aligning it to the proper asset class. So many times, whether it's been here or in a bank, I see customers come in and they have equipment sitting on their line of credit. They have heifer development. Guys, if you raise cattle, there's more than likely heifers on your line of credit. That needs to be put on a 3 to 5 year note. There's a reason that banks put them on a 3 to 5 year note if you go buy them from somebody else. They do not expect them to pay for themselves in the first year. We need to understand that. That's not so creative. But getting into more creative terms, when we talk about creative financing, there are ways to look down the road. There are some predictions that interest rates are going to go down. Those predictions have kind of backed off a touch, but we're still projecting anywhere from 25 to 50 basis points, okay? Basis points meaning 0.25 to 0.5% interest is what we could see. Do we want to capture that? Absolutely. So why would you lock down an interest rate today? Find a way to float interest rates for the interim by protecting the short-term risk. Get into a situation where you understand where your downside is. Go look at creative financing through leasing terms or balloon payments. There's a lot of ways, but ultimately it comes down to understanding your numbers and your risk profile. So starts with contacting somebody like a knowledgeable banker or more importantly, somebody at like Legacy Farmer. And we can really walk you through and really dive in to those plans and help you understand where you should be going forward. So I want to take a minute to ask Katie, how do we currently connect legacy farmers to marketing plans? Because this is really your area of specialties.
Absolutely. So the way that I kind of like to work with customers is I always want to meet with them and just get a baseline understanding of their actual operation and farm, because every operation is different. Then we're going to really focus in on farmer metrics and using the tools and data that we have from there to understand the break evens, the cost of production, and using that information, using information like their local basis, where they can deliver to, what products are offered at those different delivery points. We're going to use all of that and really make a specific marketing plan that works well for their business and allows them to be profitable and have that continuity from year over year. So it's really very specialized to like each individual person, but it's a fun process to just get to, for me to understand your business, but then also to see those actions go into place and see that difference after a year of actually having a plan rather than, flying by the seat of your pants and allowing emotion to come into some of those decisions.
Yeah. So that's what we had for you today. We're going to kind of move into some questions, some Q&A. And we'd love to hear what you have, what thoughts are in your mind, concerns, fears, all that stuff. And we'll try to give you some kind of guidance. Okay. The first one that just popped up. Katie, this is definitely a question for you. Should I be forward contracting corn right now, or should I be waiting?
It's a great question. I think we've watched this market feel a little bit stronger, especially on the near side. We aren't seeing quite as much of that action in the deferred contracts, so those new crop contracts. I personally think we're going to have some great opportunities to market corn in the next month and a half. Seasonally, we typically see the highest prices in April and May. We haven't quite seen as much seasonal strength as I would like to at this time of year, I think because the planting progress has been going so well. But as it tends to be, we always see some type of weather volatility come into this market. It's definitely a good time to understand your marketing plan. I mean, honestly, we should have had that in place a few months ago. But when it comes to forward contracting, we really have to consider all of the options, whether those are HTAs, forward contracts, structured products, or just using futures. If you have a elevator offering structured products such as accumulators, and those levels are very attractive, there's no reason not to kind of consider some of those options at this point, because you're going to see a little bit better value in those currently than you will see in a couple months. So that's one thing to be considering. But in terms of just HTAs and forward contracts that are based off of futures, I think we have a little bit of time there and can probably wait to see if we see some better price strength from weather volatility in the next month and a half.
Yeah, I think that's a really good response. Guys, if any of those terms that Katie just threw at you don't make sense, there's your first sign that you need to be reaching out to her for help, because we have a market expert here that can help you understand that on a granular form. And I think ultimately she can benefit your operation. Now, there was a question that came up that I think I'm going to take a shot at here. Is leasing equipment a smarter move this year with all of the uncertainty? Guys, there is no universal answer to that question. It's a case-by-case scenario. We got to look at what the current cost of ownership is at our machinery and really understand those costs before we start making decisions whether leasing or purchasing is a good plan. I'm going to tell you just in general, if there is a general consensus, don't lease grain bins. If anybody ever tells you to lease grain bins, I do not consider that a leasable structure. And then don't lease implements. You own your implements. The ones that we're really going to start looking at are that rolling stock or harvest machinery. That's really where we're going to dive in. Those are the big ticket items. That's where that decision point comes in. But once again, understand your numbers before we can start making those comments. Katie, here's one for you. Do you think USDA yield projections are too optimistic right now?
Yeah, so I'm assuming this is probably talking about the corn, just because that's where we're seeing some of those more optimistic yields being at that 181 bushel per acre. I think this estimate aligns with their long-term trend yield that we typically see increase each year. So it's pretty balanced in that sense. However, I do think there should be a little bit of caution taken with this. we've seen the USDA yield projections be a little bit too optimistic in recent years. I think a couple years ago we saw them at like 177 and a half, but the yield in 2023 is actually around like 173. So I think that discrepancy kind of raises those questions about the reliability of these trend-based projections, just because of how much weather issues we have nowadays. They're not really considering these weather events and planting decisions when they're just having these trend by trend increases in yield. So we'll see an interesting year. I think it's going to be very much weather dependent. I think we need this yield to be able to make up for those old crop stocks. So it'll be really important and probably lead to a little bit more volatility than we typically see. Also, a good thing to note is just the fact that we've seen this increase or significant increase in planted corn acreage. We have to consider how that can impact yield per acre, because while we're expanding acreage, we might be boosting our total production, but it also can lead to a dilution of average yields as we kind of put in some more or less productive land into our acreage.
So it's funny that we're kind of having this discussion. Katie and I kind of had a side conversation. I really enjoy picking her brain, but we were talking about just the archaic methods that we still have in terms of estimating yields, particularly when we talk about one of the biggest events in the industry, which is the Midwest Crop Tour, right? They have people that are coming from these trading desks out counting ears of corn. You and I both know that one part of the field may produce totally different than another. All of us get really excited. We're in our combine and we're looking at wheat, and all of a sudden it hits 100 bushels per acre for like 20 seconds before the average turns into 20. You know, that's something to consider whenever we're taking in this information. For some reason, with all the advancement in technology, we still have this very rudimentary way of going about and estimating yields. So for me, kind of sitting back in a different chair, it makes sense why they're off all the time. Seed technology keeps progressing every single year. Ironically, unironically, better yet, if the weather patterns stay relatively the same, we should expect yields to continue increasing, which could have an impact on price and will have an impact on price. But here was one that I think I'll dive in. This is a little bit of a touchy question. Is it smarter to work with a local bank or someone bigger like a farm credit? Guys, that depends on the bank. That depends on the farm credit system that you're dealing with. As a general rule, I'm a fan of farm credit. It was set up for farm and ranchers. It's managed by farm and ranchers. The people that are on their board of directors are all coming from their borrower, the base of borrowers that they have. So the decisions that they usually make have to somewhat align with the farm in a way that sometimes commercial banks can't emulate. Plus, their funding structure is different. Farm credit doesn't pay taxes on their long-term funding, such as their real estate loans. So they can offer you a lot longer terms and a lot better terms in terms of interest rates. Now, there are some commercial banks that have partner with Compeer Financial and people like that get their money from farm credit. There's some options there. It depends on the banker and it depends on the farm credit system. So make sure that you're really paying attention to what that looks like in your current area. You know, kind of wrapping things up, Katie, I want to talk a minute about farmer metrics and kind of how that's going to help these guys. Guys, when we bring you into the system, this is how our legacy farmer system works. We're going to focus very, very hard on understanding your balance sheet and your cash flow, making sure those numbers work together in a very intuitive fashion. That intuitive fashion brings clarity to people across the country every day. And it's an exciting moment for me. It's an exciting moment for Katie when that does happen. I honestly believe this is going to be the difference between these guys staying in, passing on the next generation, and having a legacy that lasts for many more families and many more generations. And we would love to help you. We would love to help you get there. After the cash flow, we dive into field metrics. We get an idea of what it looks like from a granular level on a field by field, crop by crop basis. We can really help you understand your marketing plans. We got a marketing specialist here. It's one of the best and brightest minds of the industry right now. And she works here with us. She will work for you. And you just got to make that initiative. You got to go out there, click the button. Let us help you. Go in there, try the free software, reach out to our team, and our team will show you what can happen. Make that step for clarity, and I think you won't regret it ultimately. We really appreciate you guys joining us today. And we hope to see you in the near future in a coaching session.
Before I started using Farmers Metrics, it was just a lot of spreadsheets, guessing, math in the head. Looking back, it was actually a huge guessing game, and that's not the way you should be running a business. With the metric software, it was an eye-opener as to how inefficient I actually was. It makes everything with relationships easier if you know exactly where you are financially.
It's definitely challenging not knowing where we stood financially as far as the farm meeting our goals, and it's kind of hard to create goals when you don't even know where you're at.
We're pretty close with our loan officer, and so she knows, a lot of our situation. I had mentioned that we joined Legacy Farmer. You could see that she gained confidence in our operation by seeing those, the work that we had done.
Before Farmer Metrics, there was a lot of uncertainty and a lot of unknowns, and I know he missed stuff. Just not exactly sure. Is this business making me money? Is it draining me? I'm not sure. No, it's really easy to use once you understand what it's trying to ask. I find myself touching up numbers and getting as accurate as I can, and it helps me sleep at night.
For using this software, I think there was a lot more stress within our marriage, just having this financial weight on your shoulders and just trying to think of okay, how are we gonna do this? But now it's okay, let's get this done so we can get it into Farmer Metrics so we can continue to look at our bigger picture. Our banker came in and he did look at the software and he did not have one negative thing to say. He absolutely loved it. He's a big spreadsheet guy. He makes me a little crazy when he puts the spreadsheets together because it makes my head hurt. But he was very impressed with the software.
Farmer Metrics, basically what it did was it allows us to kind of deep dive into the true cash flow of the farm and the projections that kind of go from there. And then it helped us segregate out basically our real assets and kind of how they look, and it just showing that type of stuff as well.
With the software, I can do it, anybody can do it. I'm not very savvy when it comes to that kind of stuff. Very user friendly. That's where the QuickBooks was nice to already have it in there and just go backwards off your monthly profit and loss to get your cash flow going. Knowing my finances better has allowed me to make better decisions, quicker decisions, and more confident decisions.
If you're in a similar situation and feel like you need help, especially with your numbers and just a community, I would say join, and the sooner the better. As long as you put effort into it, you're going to get plenty of value out of it.
Do it. You will not regret it. I think it's money well spent. I think it's been great for the business. I think it's been great for our marriage. Truly and honestly though, this really has been a full game changer. I felt okay, we can go off the farm for a minute. I think anybody that has felt the way that we felt should do this program.